Hey, this is Justin with DayTradeTheMarkets.com, and it's Wednesday. It's actually 12/12/12 today, which is unique. So, in today's video, we had some major news. Obviously, in the index markets, we had the FOMC meeting, and then in the crude oil, we had our normal Wednesday morning crude report. And so, I thought I would just take today's video as a chance to really focus in on trying to make sense of volatile market events that are often caused or often coincide with major news events as well, and focus on a way to stay out of trouble, stay out of some painful events, and also take advantage of the volatility that is brought about by these news events, and try to get on the right side of those news events. And so to do that, what I'm going to do is I've stripped off everything on our chart except for what we call our major structures, to give a little bit of a background on that. Within our software, we have various pieces of evidence that form in real time, and among those are the relative aggression bars, support resistance zones that form in real time, a filter that's forming in real time, and then deceleration bars as well that are forming in real time, as well as something we call high velocity moves, which I don't have listed here. And the idea here is that each of these pieces of evidence is giving us information. It's giving us order flow, market-driven information about what's basically going on, I guess you could say, under the hood of the market. So it's giving you really unique, good information in real time, and the idea is that the more of these pieces of evidence that come together or confirm what you may be thinking, the better edge, the better handle you have on the market, so you can basically stay out of trouble, avoid more losing trades, get into more winning trades. That's the idea. So this is a tool that's giving you real-time, really quality information that you then dissect as the trader to make sense of what's going on in the market to help you stay on the right side of the market. So now with that said, what I'm going to do in this video is take off all of these and just focus on what we call our relative aggression bars and our high velocity moves. And to give a little context on that, we have three levels of relative aggression bars, both buying and selling. We have the level 1 or moderate buying bar, level 1 moderate selling aggression bar, then we have strong buying, extreme buying, strong selling, and extreme selling. And so what I'm going to do in this video is just keep on these. So I've turned everything else off of the software except for these level 2 and level 3 buying and selling bars. And the reason I'm doing that is because it's basically our first, what we talk about is our first building block to make sense of what's going on in the market. And we ask ourselves, when one of these major structures comes in, do we have follow through in that direction, or do we have rejection? Because that's going to give us a very good handle on the likely short-term direction of the market. So let's look at the first basic news event today, which was in the crude oil market. And this is on Eastern time, but around 10:30 we have the crude report on Wednesdays. And the first major structure that came was a level 3 extreme selling aggression bar. And so our first expectation when that happens is that the high is going to act as resistance. It should hold. And as long as that holds, we have to say that the bears are in control of the market. So we ask ourselves, then do we have follow through? And clearly we have follow through here. And so at that point, we can say pretty clearly, when this major news event happened, that at least in the meantime, bears are in control. And you can see there was another follow through event there with a level 3 selling bar with follow through, level 2 selling bar, level 3 selling bar, and then this level 3 selling bar as well. And this was when this high was taken out, which you could see right here. That's our first clue that at least this wave of selling, this 50-60 cent move in crude, is at least the pure selling dominance is over. That doesn't mean buyers have come into the market. It just means that when that high got taken out right here, the pure selling dominance was over. Okay, so it wasn't until here around 11:30 Eastern that we got our first sense of some major buying coming into the market with this buying level 3 buying aggression bar. And so again, our expectation when this comes in is that the low of this should hold, and if we can get some follow through above that, that's a pretty bullish indication. And you can see then that when that happened, the market took off and had another big move. Wasn't until the low of this bar got taken out that we had some selling come into the market. And you can see that that's kind of how, just again, not looking at the filter, not looking at the support resistance zones, not looking at deceleration, just looking at these major structures is giving us a pretty good handle on at least the short-term direction of the market. So when you get into volatile market situations like that, you can at least, if nothing else, I mean, you can go way beyond this, but if nothing else, you can stay on the right side of the market, and that's obviously going to add up in the long run. So let's look now at some of the index markets and look at the around 12:30 Eastern. We had the FOMC meeting, and the market had been pretty slow up to then. So let me throw on the let's just look at the ES, or the E-mini S&P. And again, you can see here at 12:30 Eastern time was the Fed announcement. And so the first, often there's kind of a the old two-step when the Fed announces, but here was the first major structure. It was an extreme buying aggression bar. And so again, our expectation is that the low of this bar should hold. And you can see we did not have a full bar below there. This bar, certainly the low, that certainly got tested. It wasn't tested on any strong selling aggression. And then we had another level 2 bar come in right there. So, that's a pretty good clue, and it was even more so when this high got taken out afterwards. Pretty good clue that the buyers were being more aggressive after the announcement by the Fed in the ES. Here's another structure, Here's a buying structure here that didn't really have as much follow through. As you can see, its high did not have a full bar below, its low did in here. And so that's our first clue that at least this dominant wave of buying is over. And again, it doesn't mean sellers have stepped in. It just means the dominant buying wave, the one-sided vertical move, is at least over for the time being. Now we could have had another vertical move start here. We didn't. The next structure we had was a selling structure there, and you can see that its high did hold, and then a selling high velocity move there, buying structure that was rejected, a buying structure that was rejected, and you can just see how these aggression bars, not looking at anything else, but just these aggression bars can help you stay on the right side of the market, especially on a volatile type situation like the FOMC. So buying dominance, selling dominance. Selling dominance is over, two-sided at this point. Okay, it's just a good way to keep yourself on the right side of the market. Let's look at the Russell. Very similar, obviously. The Russell did have more of a sell-off today, but the first structure after the news was this level 2 bar. Its low was tested, but it did hold, and we had a wave higher. This level 2 structure had no follow-through, did have rejection. A little bit of a back and forth here, and it wasn't until, but again, these are level 2s as opposed to level 3s. This was a level 3 buying move, which again is an extreme. It's got more power. You can see no follow-through, rejection on the downside. Pretty good clue, at least for the time being, that sellers were in control. And this is confirmed by this level 3 selling bar, another level 3 selling bar. You can see that at this point, sellers have really stepped in to become dominant. And then at the low here, you can see when we had this this level 2 bar had its high taken out, a full bar above these level 2 buying bars, that at least this dominant selling wave was over. Okay, that's the Russell. Let's look at the YM, the mini Dow, then I'll look at the Euro. Here's the mini Dow. Again, same idea. First structure was a level 3 buying bar. It certainly had its low tested, no full bar below, and it was even tested on some strong selling or extreme selling aggression. However, you can see that as soon as that bar formed, and again, that's a normal kind of the old two-step that happens with a Fed announcement, so that's it gets extremely volatile at that time. But you can see that this bar, we still hadn't had a full bar below it. The bar that tested below it was a level 3 bar, but that was quickly rejected. We had no follow-through lower. Its high was taken out quickly. Full bar above, again, a pretty good clue. We had this little two-step battle, buying, selling, buying one. Let's head higher. And you can see some selling started to come into the market again in here, rejection of the level 3 bar there. Get the idea, I hope. Let's look at the Euro. Same idea here. Well, we had a level 3 bar there. That's a pretty good clue heading into the news. High velocity move at the news. Level 2 bar, level 2 bar, level 2 bar. It wasn't until this level 2 bar got rejected that we say, okay, the buying dominance is over. Some selling started to come into the market. So hopefully that makes sense. Again, the idea here was not to look at the full chart, not to look at everything, but just the first building block, which are the strong and extreme buying and selling aggression bars, and how simply using those during volatile periods of the market or news events can at least help you stay on the right side of the market. We have trade entries and all sorts of things that we like to focus on. But I think the key, it's a very subtle point actually, and if you're still with me, I hope you can get this. What I think, not what I think, but what a lot of traders do, most traders do, and this is why most traders lose, is they focus on trade entry ideas. They focus on ways to get into the market. What we believe and what we have seen work for trader after trader is that if you can first focus on the context, or making sense of the market, putting the market in context, understanding the likely short-term direction. Are we in a consolidating market? Are we in a vertical or breaking out market? If you can first put the market in context, that's the key. Then once you've got the market in context, once you know, for example, with relatively high degree of certainty that buyers are in control of the market, then you look for a way to hone in on really good low-risk trade location for a long trade. And then we have a lot of ways to get into the market. I can certainly send you some material on some of our individual trade entries if you're interested. But I hope you understand the idea that I'm talking about. Context first, then trade entry. Most people are just focused on trade entry. So hopefully that helps. If you have any questions or anything about this or anything that we might do, by all means let us know. Hopefully you found this educational and interesting. And we'll talk to you soon. Thanks.